With a badly battered economy and no new stimulus plan from the government, investors are wondering what else the Federal Reserve might be able to do to support the economy as we head into a new year. Our Fed expert, Brian Cheung, is joining us now. Good morning, Brian. I know that you spoke with Chicago Federal Reserve Bank President and CEO Charles Evans recently about that and a whole lot more. What did he have to say?
Yeah, well, I had a chance to speak with the Chicago Fed President Charlie Evans last night, and obviously with all the headlines today really being all about the fiscal stimulus talks down in Washington, D.C., I asked the question that if it is indeed the case that we don't get any sort of stimulus package, maybe by the beginning of next year, would that increase the onus on the Federal Reserve to do something in maybe 3 or 4 weeks in their next FOMC or in their last FOMC meeting in mid-December? Here's what the Chicago Fed chief told me in response to that question.
Well, I think it makes for a much more challenging economic environment, and our outlook would undoubtedly be adversely, affected. When I submitted my forecast, I had, somewhere, close to $1 trillion of fiscal support that I was expecting. So if we got nothing, that means that aggregate demand deficiencies are going to be that much more of a concern. And that would slow down the pace of the recovery. We would end up with higher unemployment rates, and that would be a challenge. I think, monetary policy would, we need to think about how we respond to that. But the best course of action, when you think about what we're doing with lower interest rates, we're trying to make borrowing conditions more attractive so that households, businesses can undertake investments which have some risk component to it, and so lower borrowing costs, provide an incentive for them to do that. In so many cases, small businesses are on the edge of not being able to go forward, and their employees are at risk. So many of these enterprises really need grants, outright relief, not just more debt. So that's where the fiscal support comes in. Then the other side of that is state and local governments are also very challenged. They can't they have to balance their budget, so they can't just run deficits endlessly. Federal governments, got more advantages there, but they can increase debt. But state and local governments have to balance their budgets, and when their tax revenues are a lot lower, they're probably going to have to, cut back on employment. Employment in state and local governments is about 10% of total employment in the U.S. economy, so that would be another, definite hit to a stronger outlook. It's just some things that we have, as a country, the ability to address in a more meaningful fashion. That would be helpful.
And you can hear it right in the tone of the Chicago Fed chief that the odds of a stimulus package likely don't look good based off of what he was saying, listing the impact to state and local governments. That's been a concern specifically in his Fed district. When you consider that the Federal Reserve's municipal liquidity facility, that backstop for funding for state and local governments, has only been tapped by 2 bodies, one of them being the MTA here in New York City, but then the other being the state of Illinois. That was actually the first one to tap the municipal liquidity facility. Now, Charlie Evans saying, broadly speaking, that yes, fiscal stimulus would have really helped specifically businesses and households during this time. But he did say that if it is indeed the case that we don't get a stimulus package, that would force him to revise down his forecast. Because as he mentioned, his modal forecast, which he submitted in that September 16 FOMC meeting, assumed that there would be $1 trillion of fiscal stimulus. So if that isn't the case, it likely means that not just Charlie Evans, the Chicago Fed, but many other Fed policymakers might want to have a more gloomy forecast if there is no help coming from Washington, D.C.
Brian, we've heard Fed Chief Jerome Powell recently again warn about the need for stimulus. Now you have Evans saying, hey, we need more stimulus. Are they essentially setting up investors to expect really downward misses or downward surprises in some of this economic data over the next few weeks? Like, certainly the last jobs report disappointed. Other data has held up, but are they setting the market up for a fall here?
Well, I think it wouldn't be very controversial to say that nearly every Fed member would say that it would be bad for the economy if we didn't get any sort of fiscal stimulus there. But I think we have to add up in sum the forecast that the Federal Reserve officials have already offered and changed over the past few months. When you consider that the modal or the median member of the Federal Open Market Committee has actually revised up their expectations for this economy over the past few months. When you consider that, for example, Charlie Evans even saying in that interview as well, the full clips of which are, by the way, on yahoofinance.com right now, but he said that labor markets have improved more quickly than he expected. In fact, if you look at the June projections of where unemployment would be by the year end 2020 compared to the September forecast that the Fed had, they revised that upwards because it did seem like the reopenings were going much faster than the Fed officials had expected. Of course, if you still have unemployment almost at 8%, which was the case as of the last September report, you still have a long ways to go. There are still over 10 million people out of a job compared to pre-pandemic levels. So Fed officials are not saying we've recovered it all, but what they are saying is that it has been a little bit faster. But if you get that fiscal stimulus headwind of effectively no help coming, that would create a headwind that would really maybe sink down forecasts even further, which would quite frankly alarm a lot of those Fed policymakers, which is why you've heard some of these Fed officials, including the chairman, Jerome Powell, be so aggressive about saying we really need that direct help to households because they are the ones that can offer those grants that can be forgiven, which the Federal Reserve cannot do because they can only lend, not spend.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.